The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The risk from war remains, but investors, well, they seem ready to move on. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell here in the U.S. Let's take a look at where we stand, because just in the past 20, 30 minutes or so, quite a reversal that we've seen. The S&P 500 actually giving up all of its gains, now pretty much unchanged on the day. That's after the U.S. confirmed that it hasn't actually escorted a tanker through the Strait of Hormuz. More on that in a little bit. You can see the VIX still down on the day, though. We're trading with the 24 handle. Gold higher by about 1%. And the 10-year Treasury yield, once again, offering no sort of haven protection here. Yields higher on the 10-year yield by about 4 basis points, Romaine.
Yeah, it was interesting earlier in the session to see how investors really were trying to build on yesterday's rebound rally, though the fog of war still hovers over any bullish enthusiasm. Still, we should point out that the sharp move that we saw higher yesterday was really a testament to how a lot of folks out there are still focused on corporate bottom lines and, more importantly, continuing to try to climb that proverbial wall of worry. But it is a wall that could have at least 2 more sets of bricks added to it over the next 24 hours. The first, well, that's going to come from earnings after the bell tonight from Oracle, one of the highest flyers in the AI build-out that has recently become one of its biggest dogs. The stock plunging more than 50% since its record high back in early September, the worst performer in the S&P 500. And while the company's revenue is still growing, up 20% based on expectations, margins, they've been slipping, feeding into one of the biggest fears about the AI boom, which is that for now, the cost to meet customer demand is still outpacing the value of that demand. Then about 16 hours later, we get the U.S. consumer inflation report for February. Bloomberg Economics expecting a subdued core CPI reading, though it does flag some hot spots on inflation, like consumer electronics and recreation goods and services. The real questions, though, they won't be answered in the report itself, which was collected before the war in Iran kicked off and kicked up energy prices to their highest level in years.
Let's take a look at where money is flowing when it comes to how ETF investors in particular are investing their cash. I want to take a look at bond ETFs in particular. We have data through the first 2 months of the year, so through February. We know that in March, of course, bonds have been a bit unreliable when it comes to their hedging properties. But take a look to the start of 2026, taking in over $100 billion, again, just in the first 2 months of the year. You compare that to years prior, going back all the way to 2007. That is the strongest start to a year in this data that we have behind me. Of course, the question is, Romaine, as you know, we get deeper into the conflict in the Middle East, into these geopolitical tensions, and into potentially a rise in inflation, what will this picture look like? But at least for the first 2 months of the year, bonds were certainly on the menu.
Interesting to see what the third month of the year brings. Stephen Laipply joins us right now to discuss, global co-head of iShares fixed income ETFs over at Blackrock. And Steve, we've had you on this year alone to talk about some of those inflows that we've seen into the bond space. Maybe just put it into context, though, of what's transpired over the last week and a half and whether that changes structurally the broader narrative that had led to those inflows earlier this year.
Yeah, Romaine, I think there's a lot of headline volatility. I mean, obviously, energy is top of mind. Oil price is top of mind. But if you look at the market and where break-evens are in terms of inflation, we've seen some movement, but not a lot. And if you look at forward indicators, they're relatively stable. So I do think there's a lot of noise, but investors seem to be looking through it and continue to view this as a very profound opportunity in fixed income. Yields are still very attractive, and investors are voting. They're voting with their dollars.
I am curious, though, about the potential for a resurgence in inflation. Even before the war in Iran, we had gotten some sort of trickles in some of the reports here that seemed to suggest that the inflation beast hadn't been slayed. If we do see a material pickup in some of those official inflation numbers, does that maybe scare away some of these bond investors, at least at current yield levels?
I think it changes maybe the allocation mix. So I don't think you're going to see people shunning fixed income wholesale. I think what they may do is they may move further, towards the front of the curve. We've already seen, close to $8 billion move into SGov, our 0 to 3 month T-bill fund. We've seen a lot of flows into our fixed maturity suite, our I-bond suite. And so I think you'll see more allocations like that, probably more into inflation-linked ETFs as well. But I don't think it actually changes the trend of investors wanting to have fixed income exposure. I mean, we're up 35% flows relative to this time last year.
Well, you mentioned SGov, of course, your ETF that tracks sort of short-term Treasury bills. That has actually seen the biggest year-to-date inflows of any fixed income ETF in the U.S. But overall, I want to talk about the trend because you say that investors still interested in bonds here. Really interesting data coming from Bloomberg Intelligence, taking a look at the share of bond ETFs relative to the total ETF market overall. Just 17%. That compares to a pandemic era peak of about 23%. So hundreds of billions of dollars still floating into fixed income ETFs, but their share overall going down. I wonder what you make of figures such as that.
Yeah, I mean, I think it's a point in time. I think if we sort of fast forward, several months ahead, we might see that normalize. And overall, it's just the way investors are thinking about their asset allocation. It's not 60-40 anymore. Investors are broadening out their portfolios to alternatives. They're looking at digital assets, et cetera. So part of that may also just be a change from the traditional 60-40 equity bond allocation.
And you mentioned that, in addition to what we're seeing at the front end of the curve, clearly a hot spot. It has been for years here. Perhaps inflation-linked bonds, maybe that sort of protection coming into demand. Are you seeing that when it comes to BlackRock's own lineup? Because, again, I look at some of the numbers. It just seems like people want cash at this moment.
I think most of the flows have continued to be concentrated in, the high-quality buckets. So we've mentioned SGov. We've seen flows into other Treasury ETFs as well. Investment-grade corporates are having a pretty solid year so far. Then you get down into, things like municipals and high yields, a mixed picture. So people seem to be a little bit sideways on that. But overall, investors seem to be leaning more towards high quality. Have seen some inflation flows. I mean, we did launch a 0 to 1 month inflation fund, ICPI, and that's meant to allow investors to really just target as close to pure break-evens as possible. So we've had some inquiry on that. But I think overall investors are really leaning into high-quality income.
I am curious, though, too, when we talk about high-quality income, Steve, the idea here that you have a lot of corporate players now coming to market, high-quality corporate players coming to market. Obviously, that behemoth of a bond sale coming out of Amazon. You've had a few others, including Microsoft, also potentially coming down the pike here. Is that competition for Treasuries?
I mean, I think investors are going to do the relative value trade-off. Investment grade spreads were fairly tight. They have backed off somewhat. We're out, closer to that 80 basis point range above Treasuries. So investors are going to probably, do their relative value homework, but it's not either or, it's both. And so it's just the relative mix that's probably going to be in flux there.
And I do want to get your thoughts on, a topic of conversation I've been pursuing, and that is how buffer ETFs sort of wrap into this mix, because the conversation we've been having on The Close is basically, you think about bonds being sort of an unreliable hedge. You've certainly seen that over the past 10 days, and on and off, you've seen that over the past couple of years. Some investors, some endowments even, have sort of rotated into buffer ETFs as an alternative here. And I'm wondering, whether you're seeing that, again, within BlackRock, which does offer both categories.
I mean, I think we've seen a lot of interest in our buffered products. I don't necessarily think they're a pure substitute for fixed income. We have seen investors look at both in the portfolio. So, it's more of really trying to define what your equity bucket should look like and how it should perform under different market scenarios. But I don't think investors are necessarily looking at them as pure substitutes, more as complementary in the portfolio overall.
Steve, always a pleasure. Stephen Laipply, Global Co-Head of iShares Fixed Income ETFs over at BlackRock, kicking us off to The Close here on this Tuesday afternoon. We talk about the wall of worry that investors have to climb, but so too do America's CEOs. KPMG out with its latest CEO Pulse survey. KPMG's U.S. CEO, Tim Walsh, joins us in a second to discuss.
We'll also take a look at the tech landscape with those Oracle results out after the bell. Charles Phillips, managing partner and co-founder at Recognize, a tech-focused private equity firm, joins us to discuss the biggest trends in AI and if he's seeing any cracks when it comes to funding. And two of the most volatile days in the oil markets in years. A conversation up ahead with Richard Haass about the situation in the Middle East
and where we potentially go next. All that and more coming up in a bit. This is The Close on Bloomberg.
Bill Ackman's Pershing Square filing for an IPO on the New York Stock Exchange, looking to raise up to $10 billion in a combined offering for a new closed-end fund, as well as the hedge fund management firm. Joining us live with more is Bloomberg's Bailey Lipschultz. So, Bailey, going at it again. This is the latest attempt to pull off this IPO.
The latest attempt to go. So back in 2024, quick turn to about 2 years ago, wanted to raise up to $25 billion in just a closed-end fund. That would help pave the way to take the management fund public in a separate deal. Well, now here we are in 2026, and the game plan is raise closer to $5 billion for the closed-end fund. And from Ackman's point of view, hey, for every 100 shares you buy in the closed-end fund, we'll give you 20 shares of the management company. So maybe a bit of a sweetener, depending how you want to look at it.
How does this tie in at all with Howard Hughes and the investment that he's built into there? Is that completely
It's separate. It's part of the empire, or at least the proposed empire. I think it's part of the broader strategy for Pershing Square, but this seems to be a more accelerated way to take
this idea. I get the more direct investment into this rather than if I try to go through Howard Hughes.
Yeah, you're not worrying about the Howard Hughes. You actually would own how they have to figure it out. It's being treated almost as a direct listing of the actual management company, but you would have stakes in both that you could sell. You could turn around and
now,
trade.
am I getting a piece of Ackman himself out of this? Like, what happens? Is this like, when you subscribe to like Tony Robbins and I can call him on the phone in the midnight and say I'm having issues?
He wants to be like Warren Buffett. Like on the roadshow 2 years ago, it was like, I want to have an event that people are sitting in and talking about, like the vision for Pershing Square. Again, that effort fell short.
Right.
This is the view, though.
I want to talk about the closed-end fund portion of this, because I think back to 2024, I mean, the fact that closed-end funds tend to trade at discounts, and certainly you can see that with this European listed vehicle. How does that sort of factor into this picture?
Well, I think that's the issue. So that European vehicle trades at a 27% discount. Ooh. So we saw Robinhood's private closed-end fund open at a 12% discount to what they just paid for the shares. So when you look through talking to some investors or people who are going to kick the tires, it's kind of, okay, well, you're getting 20% stake, essentially 20% free if you want to view it, in his management fund. Well, maybe that makes up for the likely discount. Also, Matt Levine kind of called out, there are underwriting fees, and you also then have to turn around and deploy the cash, and closed-end funds haven't worked out.
You know what doesn't tend to trade at a discount is the humble ETF. But I have to imagine that a closed-end fund, part of the appeal here is permanent capital.
Permanent capital, permanent fees. You're going to get 2% on, in theory, $10 billion. And then if you execute from there, it's easier, or at least it's viewed as an easier sell as opposed to ETFs where one day you're hot and then all of a sudden you're not.
All that money can leave.
Any concerns, though, about just market conditions and whether they're going to be actually palatable enough to pull this off? I mean, I don't know. I mean, we're in interesting times right now.
And that's the interesting thing, though. So they file the paperwork this morning. You have at least 15 days before you can even formally start marketing this. Okay. So you would take at least a week.
So that pushes them into
Look at
what?
The holidays, though. Yeah. So all of a sudden, you're really not thinking about probably launching this until the other side of Easter. And
so that's
what was life like a month ago? So, and that's launching it. You're not pricing it until a month and a week.
Yeah.
The world changes quickly. And it also is going to cater to a different investor. Ackman in the letter was basically like, hey, market's turbulent. Why don't you give us money to invest it and buy stocks low, which is different than trying to kind of do the math on an IPO.
Really quickly here, Bailey. So we talked about the closed-end fund, the actual hedge funds going public. I mean, how many publicly traded hedge funds are there out there? It feels like somewhat of a rarity.
It is.
6? Did you really look it up?
Yes.
That's why they pay you the big bucks. I'm just on here to talk about IPOs. Romain's the one who's got all the answers, Katie.
Man, so 6 out of thousands of stocks out there. Certainly interesting.
Well, maybe there'll be 7. Bailey, great reporting. Bailey Lipschultz there, following the saga here of Bill Ackman trying to get Pershing Square and, of course, that NYSE listing. All right, coming up here, we're going to talk Nike. The Nike brand has been on the rebound. It's Jordan brand. It's a juggernaut. And the Converse brand? Well, I don't know. We're going to talk about that when we come back after the break. One analyst on the street actually sees the potential for a sale. That conversation coming up next here on The Close on Bloomberg. Time now for our top calls. Big movers on the back of analyst recommendations. And we start off with Hims and Hers. Bank of America upgrading to neutral, almost doubling the price target to $23. The move coming after Novo Nordisk's decision to drop its lawsuit against the telehealth company and allow sales of its Wegovy weight loss drugs on the Hims platforms. Those shares, which surged 41% yesterday, adding 5% today. Next up, CrowdStrike. Morgan Stanley upgrading the cybersecurity company to overweight. The price target set at $510. The analyst says the company is a winner thanks to its AI positioning and promising growth outlook. Those shares, which have been up in the previous 6 sessions, now up for a 7th. And finally, Crocs. BTIG analyst Janine Stichter picking up coverage of the footwear company, initiating with the neutral rating. She likes what the company is doing to manage inventory, but says further sales growth for Crocs is still likely a year out due to a lack of product diversification and rising competition. Those shares, which came into today down about 15%, now down 3% here on the day, and those are some of our top calls. We do want to say in the footwear and apparel space and take a closer look at Nike. Still about 3 weeks away from their earnings report, but BNP Paribas out with a note where they suggest that the sportswear company may be getting ready to exit or dispose of its Converse business. This after a recent filing. The author behind that note, Laurent Vasilescu, joins us right now, senior analyst at BNP Paribas Equity Research. He has an underperform rating on Nike going back to 2023. All right, let's start with Converse. This has been under the Nike umbrella since something like 2003. It was never a huge brand, but it has gotten smaller over the years. And there have been a lot of speculation as to why even keep it around. What did you see in that filing from Nike last week where they announced a charge that seemed to be tied to the idea of some sort of disposal of maybe human capital or actual capital?
Yeah, thank you very much for having me. And again, excited to talk about sports, especially this week. BNP is hosting the Indian Wells Conference in tennis. So great time to talk about tennis, talk about sports overall. Unfortunately, Converse is no longer rooted in sport. It's a brand that has been focused on rubberized canvas shoes, really no point of differentiation. And unfortunately, the brand used to be at $2.8 billion in sales, has shrunk to almost $1 billion. And that's unfortunate. And the filings, what we saw from the 10Q filing in December was that they cut the marketing expense by 50%. I've never seen a brand operator cut marketing by 50%, because that's the lifeline of a brand. And then last week, just a few days ago, we saw the filing where Nike announced in the disclosure that they're announcing a $300 million restructuring program. In that disclosure, it says, disposition of assets, which would suggest that there's something going on with potential divestitures. And if that's the case, the only thing that would come to light, it would be potentially Converse.
Given the size of this, the current size in terms of revenue, and given the basically almost zero contribution to the bottom line, if they were to get rid of this, other than obviously the restructuring cost itself, would there be any really material hit to Nike itself?
I think Converse probably, because it operates out of Boston, it's probably isolated from the rest of the organization, right? You think about Nike, you think about the Jordan brand, operated principally out of Portland, Oregon, Beaverton. When you do have divestitures, you've seen that with VF Corp divest a lot of brands. You generally do see dyssynergies. You see stranded costs, and you have to have additional restructuring charges, which is what the filing showed, indicated that. Addition to the $300 million charge that they're going to recognize in the third quarter, which is what they're going to report in a few weeks from now, they may have additional charges. And, I think what's interesting is, with that, you might have the synergies with Converse, but I think the investment community is very focused not on Converse because, to your point, it's not really important.
But do you talk to the company? I have to point out, I had a chance to sit down with Elliott Hill. And I asked him specifically, this was a few weeks ago, about your note. Your previous notes and a Converse, and he was pretty dismissive of it.
Yeah, and it makes sense that they're also talking to constituents, they're talking to their employees, but we have seen a long history of divestitures, which we talked about. Hurley, Bauer, you name Starter, you go on and on, and at some point, if they divest the brand, it doesn't have a material impact. But I think what's most important, what we're going to be looking for in 2 weeks from now when they report, is really China. Because on the last 2 quarters, they've been talking about China, it's structural. And then to answer your question, yes, I give them a real applaud for keeping the communication. I was buy rated for 10 years. It's nothing personal. It just, numbers keep going down. And unfortunately, at some point, hopefully numbers bottom out.
And I do want to get into your rating, but just to finish the thought, when it comes to Converse, you mentioned that it's not really differentiated, this brand, in today's market. And I wonder, is that a fundamental issue unique to Converse, or does that have something to do with the way that Nike has managed this brand?
I think it's a little bit of both, but it kind of spills into the Nike core business. If you think about the core business also, you think about Air Force One, Dunks, and Jordans. They're great shoes, just like Converse, the Chuck Taylor, but the consumer has just moved away. Moved away from the Chuck Taylor, has moved away from the Jordan brand, moved away from Air Force One and Dunks. And that's actually really important. I think that I do applaud Elliott and the management team for going back into sport, refocusing on sport. But that's just going to take a lot longer to get that part of the business to offset the declines that we're seeing in the classics business, including Converse.
Right. And to talk about your rating, as you mentioned, you were a buy rating for about a decade. You're not opposed to the idea, but given that you have held that sell rating since 2023, I mean, what would you need to see at this point that, would bump you back up to a buy, or at least, sort of a market perform, that sort of territory? Yeah,
thanks for the question. I think it's always, stick to the numbers. The numbers, if you look at consensus, stock's really valid in fiscal year 28, which is in 2 fiscal years from now. $3 of earnings, the stock's effectively trading at 35 times, 37 times. Here's where for me, I need to see that $3 number come down materially, because we're at around $1.60. And why are we so different from the street versus consensus? Because consensus is modeling for the next 2 fiscal years for Nike overall to grow $2 billion each fiscal year. If you think about that number, it's an enormous number. It's effectively asking Nike to create an On Running or a Hoka each year, every year. And then on top of that, they need to have margins come up materially to the point where right now margins are 6%, and the street's modeling 10%. And I just can't get there from a modeling perspective.
Absolutely, certainly a long to-do list there. Laurent, great to get some time with you.
Thank you.
That is Laurent Vasilescu. He is senior analyst over at BNP Paribas Equity Research. Now coming up, Tim Walsh. He is the KPMG U.S. Chair and CEO. He joins us after the break to discuss the firm's latest CEO Outlook poll survey. We'll talk the report's range of findings spanning everything from AI to M&A. That conversation up next. This is The Close on Bloomberg. 3:30
p.m. here in New York City. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Katie Greifeld. About 30 minutes to go until those bells ring. And you're looking at a reversal in the market. The S&P 500 now dipping into negative territory. A lot of back and forth about what is going on in the Strait of Hormuz and what, of course, exactly is the end game when it comes to Iran, both on the U.S.'s part and Israel's.
Yeah, a little bit of a head fake from Chris Wright, the energy secretary, with seemingly an errant social media post about the U.S. escorting ships through there. But it's kind of interesting to see that inverse correlation between what we're seeing with oil prices and what we're seeing, of course, with the S&P and the rest of the broader indexes here. At one point, we were actually down around like $76 a barrel in WTI crude, which is kind of hard to fathom, given in 24 hours or so ago, we were up at around 120.
The volatility, especially when it comes to the oil markets, has just been stomach churning. So let's talk a little bit about how it all is impacting the C-suite, because a new survey from KPMG finds that CEOs are confident in their company's growth prospects, but just 55% and 53% are confident in growth of the U.S. and the global economy, respectively. But how does the ongoing conflict in the Middle East now come into play? Let's discuss with Tim Walsh. He is the U.S. Chair and CEO of KPMG, joining us on set. Great to see you, Tim.
Great to be here, Katie.
So this report that you put out, it's interesting because it predates, of course, the conflict, what we've seen unfold in the Middle East, in Iran. But I have to imagine that what we're seeing play out when it comes to the geopolitical landscape fits into the broad umbrella of uncertainty here.
A broad umbrella is a great way to characterize it, for sure. This has been really an unprecedented time of disruption, including with geopolitics. But it's really not just geopolitics. It is tariffs, trade policy, it's U.S. economics, it's technology investment. And the events of last week, certainly in the Middle East, are taking some of the sentiment that we're seeing in the CEO outlook and just taking them a bit further. which, as you noted, what we've seen is a disconnect between our last survey, where we saw stronger confidence by CEOs in the U.S. economy and the global economy, and we're starting to see that sort of disconnect from how they feel about their own businesses and their ability to grow versus confidence and uncertainty, I would say, in that broader geopolitical environment.
Well, it's interesting. You know, you think about tariffs, you think about trade policy. Certainly that has been the conversation over the past year, the past couple years. And I mean, heading into the events of the past 10 days, how were CEOs feeling when it comes to the state of their supply chains and the state of how their products are moving around the globe?
So CEOs have become incredibly resilient on that topic, specifically around trade policy. And you know, in that domain, when everyone thinks that it is calming down, you have different events happening. You have Greenland, right? You've got the Supreme Court ruling on tariffs, and then you've got the uncertainty as it relates to potential refunds around those tariffs. One of the huge benefits, though, and you see it come through the survey as well, is that at the moment, C-suites are using AI, including our tariff modeler, for example, and they've been using it over the last year to be able to quickly make decisions, be able to forecast over what are millions of parts, right, that are going into their supply chain, and then make some decisions. Right now, most changes to supply chains have been made, and so companies are certainly focused on cost takeout where they can and can continue to take out. And then, of course, they're looking at, CEOs are looking at how resilient the consumer will be in terms of being able to absorb price.
With regards to AI, the pace of AI innovation, is that being viewed as opportunity or as a major risk?
Opportunity, for sure. And that's certainly how I look at it, Romaine. What you're seeing come through the results of the survey is this acknowledgement that spending on AI is most certainly not discretionary. We have moved well beyond the idea that we're going to pilot AI and see whether we're going to actually invest. And we've moved very, very quickly into very significant capital investments into our businesses. And so with that will come certainly workforce disruption, and you see that certainly being acknowledged in over the last number of weeks in a number of different articles and viral posts that have been put out. But more so, how I look at it, and certainly how I see it within our business, is huge opportunity in terms of being able to grow our business over the next number of years.
How do you and other CEOs, though, measure, I guess, the potential return on that? I know a lot of people, particularly investors, they just want to look at the ROI, and I know that's kind of an imperfect barometer, certainly at this stage. But is there sort of a more, I guess, familiar way to sort of think about what that return can be or what it should be?
Yeah, so boardrooms are, that's one of the number one questions, right? Because the capital spend is really significant around technologies, and the investment takes time to be able to understand what that ROI is. You see that come through the survey as well. You see this concept of CEOs saying, you know, this year it seems to be that AI is really hyped, right? It's very, very loud, you know, in terms of, you know, what's happening, how fast can you move, what's happening to your business. And the reality of that is these technologies take time to embed in your business. You need to redo process flows before you can put that technology in. You need to make sure your data is clean in order to put the technologies on. And then you can start to see the return on investment come through, and that does not happen overnight. I can tell you a measure that I'm using to see how we're doing with our investments in AI, which we've been doing for years now, is labor cost margin, which is that idea of really understanding per engagement, what is the cost of labor, what is the cost of technology, and then what is my overall cost to deliver my engagement? What I can tell you is the cost of labor, as it comes down over time, is offset by the cost of technology. And so where that actually lands over time will be really interesting. What is for sure is that as we embed technology and companies embed technology into their businesses and platforms, the volume of work that can go through those platforms will be increasing. And of course, you know, this is about growth. Companies are not only looking at back office and how they do business, but it's what they actually deliver, the products and how they develop them. It's pretty exciting.
I also want to bring cyber risk into this conversation because, I mean, you've seen this pop up over the past several years, whether it's KPMG surveys or similar ones, the idea that cybersecurity is top of mind for a lot of executives. And to fold in our conversation around AI, how has that sort of changed or sort of made this question more urgent for CEOs?
Cyber risk is at the top of every C-suite agenda, and it's brought up almost every single time I'm talking to a CEO. And the reason for that is with the technology and the advancements that are rapidly increasing, including the agentic capabilities, those are being used as threats as well. So where cyber risk was certainly high on the agenda before, it's even higher, and companies need to be able to keep pace with the accelerating technologies that are being used against them. And so, you know, that's obviously opportunities for firms like KPMG, but it's a place where you're starting to see fully automated threats against businesses start to be publicly discussed. And then you take that, and we talked about this last time I was with you, which is this concept of quantum computing. And over the last number of months, that theme is becoming louder and louder, because as you think about that, we don't know when that compute power will be upon us, but the timeline continues to shorten, and that compute power provides the opportunity to break all encryption that we know of today. And so companies need to be thinking about it. They are, and they're leaning into making revisions to their businesses to be able to be prepared.
All right, Tim, great insights as always. Always a pleasure. Tim Walsh, KPMG U.S. Chair and CEO, fresh off the back of their latest CEO Pulse survey. When we come back, it's our Stock of the Hour, and it's about the intersection of the stock market and the bond market. One of the biggest days for investment-grade bond sales, and that's largely because of Amazon. That's coming up next here on The Close on Bloomberg. All right, well, the hyperscalers have, become hyper borrowers. Amazon kicking off a massive 11-part U.S. debt offering, aiming to raise at least $37 billion in the next leg of its AI build-out. Joining us right now is Robert Schiffman, who covers this space for us over at Bloomberg Intelligence. Amazon today, our stock of the hour, but we're more focused here on their borrowing binge here. $37 billion. Obviously, this is going to go down as one of the biggest bond sales, investment-grade bond sales of all time. How did the market actually take it?
They love it.
Yeah.
You know, I think the credit markets, particularly in big cap tech, are shouting loudly, the sky is not falling. There is a big difference in equity valuations and bond valuations. When they launched this deal, they were looking to do maybe 20 to 30 billion. They're going to print 37. Remember, they're going to do probably another 10 to 12 billion, even more equivalents in euros tomorrow morning. So probably printing $50 billion at levels that are some 25 to 30 beeps inside initial price talk. There are buyers out there, and they're in size.
It's such an important point that you think about what the stock market is saying when it comes to big tech. It's totally different than what we're hearing from the credit markets and the investors there. But even still, I have to imagine that an issuer like Amazon is in a league of its own, or perhaps a league of maybe just a handful of others in finding big demand for their debt.
Yeah, this is one of the goats of the technology industry, and there's only a handful. And it's those handful that are really leading the charge in terms of borrowing. And that's why people are so comfortable, because when they think out about cash flows over the future, they believe they're going to be there, and they're going to be there in size. Just think about Amazon's top line. They're probably going to be the first company to cross $1 trillion in revenues over the next couple years. They might generate $200 billion of EBITDA this year. So if you have $100 billion of debt, so what? You have a half a turn of leverage.
Let me throw it back in your face. Amazon is Amazon, right? Okay, how does the market take Oracle coming back to the market, or Salesforce, or basically companies that maybe aren't, at least has the same veneer and sheen that an Amazon does?
Yeah, listen, all tech is not created equal. I think the sort of the Mount Rushmore of tech, whether it's Meta, Microsoft, Amazon, Alphabet, they're different. Somebody like a Salesforce that might buy back $50 billion of stock over the next year and issue $25 billion of debt.
Not for an AI build-out, to buy back stock.
Just to protect their stock. I think they're going to get beat up pretty bad, and spreads are going to widen a lot more. You're going to see demand at the right price because they're still a single A name, But listen, there's a lot more concern about software over the next 10 years, certainly over 50 years. Remember, Amazon just printed a $3 billion 50-year tranche.
Right.
Oracle also is a different animal. They're reporting after the close. They have one of the largest balance sheets in the corporate bond market, now similar to what Amazon has.
And they're
over-levered, they generate negative free cash,
among those names.
but they're done funding for the year. They're committed to investment grade. They already did their $25 billion bond deal. They issued equity. I think the one thing that people are looking for Oracle tonight is that they're not going to raise their CapEx guidance. The equity market and the bond market right now is just a little bit sick of hearing we're spending more money and we're not making it yet. I think if Oracle hits their infrastructure and their cloud software numbers without raising CapEx guidance, we go tighter.
All right, Robert Schiffman of Bloomberg Intelligence. Great look ahead to Oracle reporting in just about 20 minutes' time. The closing bell is up next. We're going to take you there with Mandy Zhu of CBOE. This is The Close.
I think there's a lot of headline volatility. I mean, obviously, energy is top of mind, oil price is top of mind, but if you look at the market and where break-evens are in terms of inflation, we've seen some movement, but not a lot. And if you look at forward indicators, they're relatively stable.
Stephen Laipply, global head of iShares fixed income ETFs over at Blackrock. He kicked us off to the close just about 50 minutes ago. Katie Greifeld, and as we check in on this market, we should point out we are diving deeper into the red here. It looked for a while like this was a market that was going to have another big rally like we had yesterday.
Yeah, absolutely. Some selling pressure into the close. A much different picture than what we were talking about 24 hours ago. Of course, that's when we were getting sort of conciliatory headlines from President Trump saying that the war with Iran was pretty much almost over. You take a look to at where we are today.
I mean, he did say that.
Yes, he literally said that. Some mixed messaging, though, coming out of the administration in terms of the aggressiveness here.
Yeah, and I don't want to be glib about it, but it was kind of interesting to see just how strong the market rallied on basically just him saying, hey, look, we're almost done with this without any real verification or anything. And now today, I think the market's kind of coming to terms with the idea that you're still seeing volleys of missiles back and forth, either coming from Iran or going into Iran from Israel. And then, of course, the idea that we still have not had any real confirmation of any meaningful ships, whether oil, gas, cargo, moving through the Strait of Hormuz.
Well, we did briefly.
I heard. Chris Wright.
Chris Wright, of course, U.S. Energy Secretary.
He was on this program a while ago. Remember, he had a hard hat on. He was talking about Emery Horton.
Yeah, it was pretty cool. But he posted on social media that the U.S. had escorted a tanker through. That post was since removed. We heard the White House then come out and basically deny that. So a lot of question marks here. And again, a lot of mixed messages.
A lot of mixed messages. And of course, that is adding to a tremendous amount of volatility cross-asset-wise, the bond market, the stock market, and of course in commodities. Mandy Zhu joins us right now. She's head of derivatives market intelligence over at CBOE Global Markets. All right, Mandy, first let's start off with this massive swing that we saw in oil over the last, 36 hours, spiking up to almost $120 a barrel. At one point today, WTI was down around 76, 77. I'm not sure where it is now, but it's back up into the 80s. I mean, how was this showing up on your radar?
So what's interesting, obviously, in terms of the price action, oil has been whipsawing around historic, like intraday volatility, as we mentioned. But if you look at the positioning in the options market, it's been actually remarkably consistent. Throughout the price action yesterday and today, when oil was selling off, we continue to see very strong upside demand in call options on oil. Basically, investors saying that the risk at this moment is still to the upside. And one of the things that we flagged has been the fact that if you look at oil options, like it's not uncommon for short-dated options to have basically inversion in the skew when there's a lot of upside call demand. It's very rare historically to see that same dynamic for longer-dated options in oil. So right now we're seeing skew is inverted, meaning there's outsized call demand, not just for short-dated options, but also for 6-month options. So that's the options market in oil telling you this crisis is not a temporary crisis, that prices are not just going to go back down overnight or in a week or two, that this could be a prolonged crisis.
So we're at roughly 86, 87 bucks on WTI, 91 on Brent crude. I mean, what types of strikes are you seeing the most activity at right now in terms of where it might go?
It's a range of strikes. I do think there's definitely a lot of risk been priced in terms of the right tail, in terms of significant shock to the oil market. But going back to the point, that it's rare for it to be seen for longer dated options. The last time we saw this was at the start of the 2022 Russia-Ukraine crisis, right? And 6 months, and oil prices was sustained for over 6 months after that. Before that, you have to go all the way back to 2011, the Arab Spring, to 2008 when oil went to 140. So these are only a few times over the past 30 years we've seen this kind of bullish positioning and longer dated options in oil. And it's interesting when you compare that to obviously what's been priced in the equity market, where we did see actually quite a bit of upside chasing over the past 2 days.
Well, that's exactly where I'd like to go, because when we've had you previously on the program, we've talked a little bit about the disconnect we were starting to see when it comes to index level volatility than what you're seeing at the single stock level. How have the events of the past 10 days, 2 weeks sort of impacted that gap?
Yeah, sure. So one theme that we've seen consistently this year has just been more hedging demand at the index level. That was true up until, I would say, yesterday. So skew has been steadily increasing throughout the year. In S&P, it actually reached a multi-year high at the end of last week. As I mentioned, over the past 2 days, it's been a bit more upside chasing. So people monetizing existing hedges and looking more to the upside. Whether that can continue, I think a lot of that is driven by the headlines. And I think equity investors have been almost conditioned to really believe in this taco trade or this Trump put in the market. We'll see. I caution. I think, a real war, a geopolitical crisis is very different from a trade war in the ability for the president to unilaterally walk something back and have it, not impact the broader economy.
Absolutely. I mean, this definitely is a different situation than a trade war, especially when you think that, there's folks on the other side. Iran certainly isn't acting as if the war is very complete at this moment. But compare and contrast what we're seeing when it comes to bond volatility, for example, because at least measured by the MOVE index and some other measures of volatility out there, it looks like bond turbulence clearly has picked up as well.
It's picked up. It's not to the same degree as we're seeing in other markets. And I think that's because in the bond market, there are conflicting forces, right? So obviously higher inflation expectations could mean a more hawkish Fed. But at the same time, higher oil prices will weigh down on growth expectations. And that all else equal actually should mean lower bond yields. So I think you have that push and pull in the bond market. And what we've seen actually there is the tails get fatter over the past couple of days, meaning people are pricing an increased probability of no Fed cuts this year, as well as increased probability of more aggressive Fed action because of a weaker growth picture.
I am curious, though, just turning back to the stock market as we get closer to the closing bells here. I think the last time we had you on, you talked a lot about the single stock volatility that we're seeing and the idea that there was a greater dispersion in the market. And that's been a theme for a while. Are we starting to see maybe that gap close a little bit and maybe start to see more just of that broad market correlation?
We saw that last week for sure. So correlation, you can look at the Core 1M index, which is the pricing for expected correlation in the S&P. That did go up quite meaningfully last week. And that is one metric that we've kind of highlighted as been, on a historical basis, the most dislocated metric in the equity derivatives market. It's historically cheap. And that's really because investors are really still focused on, the AI trade, the AI theme, picking out the winners and losers. But if we shift into an environment where there's now more focus on macro risk, whether that's geopolitics, whether that's growth, you could start to see correlations start to tick higher. So it's been ticking higher, came back in a little bit earlier this week, but obviously, it's still to be seen whether we shift into a higher correlation regime. And if we do, that should put upward pressure on the VIX.
All right, Mandy, always a great conversation. Mandy Zhu, head of derivatives market intelligence over at CBOE Global Markets, with stocks not far off a session lows here with the S&P, Katie, down about 0.3%.
Yeah, what's interesting is you don't necessarily see volume too elevated at this time, though we are playing sort of headline ping pong here. Certainly, we've lived through a lot in the past 10 days and maybe a little bit of a breather here.
It'll also be interesting, too. The market will turn their attention back to the AI trade Oracle earnings after the bell tonight. A full breakdown of all of that starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Masser and Nora Melinda join us now. Tim Stenovic I guess, has a well-deserved day off. Welcome to our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube. Another wild day on Wall Street. It looked like we were headed for a duality here of rallies in equity markets, but right now, the market's not hanging on.
No, not at all. And I mean, it all hinges often on what we're getting in terms of headlines out of the administration when it comes to this war. We saw that play out, certainly when it comes to the energy markets in a big way. Once again, volatility in that market, although crude, I should say right now, still down about 8.6%. But it was down as much as 20% on a headline by the Energy Secretary, Chris Wright, that was posted and then taken down.
What did he say? I'm sorry.
Well, it has.
I missed it.
Did you miss it? It had to do with the U.S. Navy supposedly escorting an oil tanker through the Strait of Hormuz, and so
did that not happen?
Has not, apparently.
Caroline Leavitt at the White House press secretary said no.
Oh.
What's interesting, Carol, and I think you pointed this out in your conversation
mistake, right?
with Joe Matthew, that it was a very specific post in terms of the timeline that this had happened within the last 36 hours. So a lot of questions being asked, I'm sure, within the administration as well right now.
Right. And we've been hearing from a lot of our sources that we've been having guests on the show talking about the idea of just staying still in this portfolio and not making too many rapid changes based off of all the flying headlines we're seeing.
All right. Well, of course, geopolitics has been the main driver of this market for the last week or so. Potentially, that attention might actually shift back to the AI trade with Oracle earnings set to cross the wire in just a few minutes. Meanwhile, the closing bells in New York basically unchanged across the board for most of the major indices. The Dow Jones Industrial Average losing about 34 points, but that's only a drop of less than 0.1%. The S&P 500, which opened flat on the day, rallied about 0.7%, is going to close lower by about 14 points or 0.2%. The NASDAQ Composite is actually going to end in the green, but basically unchanged, higher by about 1 point on the day, and the Russell 2000 lower by about 6 points or 0.2%.
Yeah, and you definitely see the negative tone or sentiment in the trade today. Just look at, Katie, the S&P 500, 356 names losing ground today, 147, though, to the upside.
Also taking a look at the sector level breakdown as well, the mix you saw there. It's actually a perfect mirror of what we saw yesterday, just 2 sectors in the green, 9 in the red. In terms of what did manage to squeak out a gain, communication services higher by about 0.3%, tech to a little bit higher. In terms of what didn't perform, energy down about 1.3%, healthcare, utilities, industrials also on the back foot.
All right, let me get to some of the individual gainers. Vertex Pharmaceuticals closing up more than 8%, best day since December of 2023. Top performer in both the S&P and NASDAQ 100. The biotech company said its drug to treat a kidney disorder met its goal in a late-stage trial, providing a boost to its strategy of moving beyond cystic fibrosis treatments. RBC Capital Markets weighing in and said the positive data showed exactly what was necessary to confirm the drug's high potential and gets the company past their key unknown for 2026. He estimates the drug could eventually generate about $5 billion in sales if it can win approval in multiple conditions. Sienna, a top performer too in the S&P 500, that one gaining ground as well, up about 6%. It's a $48 billion market cap communications equipment company. A couple things at play. Analysts raising price targets for this one since the company reported earnings last week on March 5th. 12 analysts raising price targets by an average of 24%. Needham analyst Ryan Kuntz saying several networking and optical technology companies positioned to benefit from rising hyperscale cloud spending as AI infrastructure continues to expand, and he did identify Ciena along with a few other companies as a result. One more for you, Rivian rallying. TD Cowen coming out, upgrading the automaker to buy from hold. The analysts there positive on the stock's risk profile going into the launch of its R2 midsize SUV. That stock up more than 4%, Rivian that is. Price target to 20 from 17. Stock still down about 14% year to date. Nearly 16% of the float is short. And keep in mind, this one is still down 90% since a high back in November of 2021. But TD Cowen liking it, investors too, pushing it up about 4% today, guys.
Well, let's dig into some of the decliners on the day. We're looking at shares of Boeing down more than 3% at the closing bell. This is the biggest drop since November for the stock. This is after Boeing said that a wiring flaw found on its 737 MAX will delay some deliveries of the jet. This, of course, sending shares lower at the closing bell. The company said its overall delivery target of roughly 500 of the 737 jets for the year remains unchanged, despite the quality lapse. But clearly the street is not really liking this news. We know that the stock did rebound in 2025 year to date after having a pretty dismal 2024, down about 32%. But if we look at the activity for this year alone, it's up just about 1%. So it seems as though Boeing is really trying to vie to get a lot of its investors back on board here. Moving from there, let's go to West Pharmaceutical Services. This company has struggled this year. Today, we're seeing the stock down more than 5% for its worst day since February of 2025. The stock is down about 15% this year. But today, we're seeing it lower after the company said that long-term CEO Eric Green plans to retire, this marking the second recent exec change after announcing the hiring of a new CFO last year. So some of those management changes weighing on sentiment in the trade. Lastly, let's wrap things up with Centene. This is seeing its worst day since July of 2025. This company is about $18 billion in market cap, a healthcare managed care company based in St. Louis. We did see that shares were sinking. The company said it expects enrollment in the ACA marketplace to decline by about 35% or more across the industry after some federal ACA subsidies did expire. So not great news for the company. Shares down about 16% on the day.
All right, let's take a quick look at yields here. We did see a lot of volatility in that space, but the net effect is yields higher on the day. Your 10-year yield up for a sixth day in the past 7, up about 5 basis points. Your 2-year yield up for a fifth day in the past 7, up about 5 basis points. And the longer end of the curve, you don't have it up there. Oh, there it is. The 30-year yield saw the most activity there in terms of the sell-off, with pushing yields higher by about 7 basis points.
All right. Of course, we are waiting Oracle's earnings, so just kind of glued to our Bloomberg. We'll bring you those results as soon as they cross. There we go. Stock's moving up.
Oracle shares, Oracle earnings out, crossing the wire right now. 3Q adjusted revenue does appear to have beaten estimates. The company is saying that it saw a 22% growth to about $17.19 billion. The street was looking for about $16.89 billion on a constant currency basis, up about 18%. Cloud revenue up 44% to $8.9 billion, and cloud application revenue up 11% to $4 billion, roughly in line with estimates. Software revenue also higher here off of those numbers. And still looking here, and here is your revenue guidance. The company says that for its total revenue guidance is now being boosted to about $90 billion. I need to take a closer look at that comparison here. And we need to dive in a little bit deeper into that CapEx number, which is going to be buried deeper into the release.
Yeah, still looking for CapEx, still looking for their cash flow as well. That was negative to the tune of about $10 billion last quarter. You can see shares, though, popping right now, higher by about 4%. But, Carol, it's important to note how low the bar was heading into these earnings. Their last high was on September 10th, and through today's close, down more than 50% since then.
Yeah, interesting to see. I was just kind of going through the press release looking for a little bit more in terms of capital expenditures. But what's interesting is you are seeing this stock up about 4% here in the aftermarket. So investors, at least initially, liking what they got here, Nora.
Right. And it seems as though, Oracle needed this win. As Katie was saying earlier, the bar was pretty low. But, investors will really be focused, as I was hearing from some of my sources, on the cloud business, and that's specifically how quickly Oracle can turn major bookings from customers like OpenAI into actual revenue.
Yeah, and there was a lot of discussion here coming into this. Remember, we had seen reports by Bloomberg about the company scaling back in terms of headcount, scaling back in terms of some of its spending plans with regards to that Stargate center down there in Texas. And the idea that coming into this report, investors really wanted to see what that CapEx number could be or would be, and whether they would raise it or maybe even curtail it. We are now starting to get a little bit of a trickle here about the forecast. The company saying that for the current quarter, the fiscal fourth quarter, it expects revenue to grow from 18% to 20% on a constant currency basis. The company they're guiding, so I guess slightly higher than what the street was looking for.
Yeah, absolutely. That revenue guidance, too, again, up to $90 billion, certainly catching the attention of the after-hours trade. It's going to be interesting, too, to see how this is reflected when it comes to the debt markets. Obviously, very much in focus when it comes to Oracle. Heading into this report, you consider that when it comes to their 5-year CDS at the highest level since January 2009.
All right, so I just want to go back here to those numbers here, just diving through the investor release. The company says that for the full fiscal year, which basically ends this quarter, they're expecting capital expenditures of about $50 billion. That's unchanged from its previous guidance. For the fiscal 2027, the company says it is raising its total revenue guidance to that $90 billion number, but it is not, at least not in the press release, providing a CapEx figure. So maybe we have to wait for that until the conference call.
Yeah, it sounds like that's going to be something that's certainly going to be asked about. But again, we continue to see this stock now up about 7% here in the aftermarket. So we're definitely seeing a pop to the upside. All right, folks, that is a wrap on our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romain continuing there on The Close on TV, and Nora and I continuing right here on Bloomberg Business Week Daily. Folks, we will see you again, same time, same place tomorrow.
Oracle, the biggest mover in the after-hours trade, up about 7% right now after the company beat on its fiscal third quarter numbers and provided somewhat bullish guidance for the fourth quarter. Still a big question mark about the fiscal year up ahead and just how much it plans to spend on that AI build-out. That conversation continues after the break, right here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic. That rebound rally that we had on Monday failed to extend here on the Tuesday. The S&P opened flat. It did rally about 0.7% at one point during the session, but as you can see, closing lower by about 0.2%. The Philadelphia Semiconductor Index did manage to post a gain, led higher today by Micron and Nvidia. Those software stocks lower on the day, dragged down by names like Microsoft as well as Oracle. And then, of course, all the volatility that we saw in crude oil today, basically round tripping. At one point, we were down around $77 a barrel.
But we had a lot of fun along the way. Let's talk about what we saw in the equity market. Boeing down about 3%. The news breaking that they found some wiring issues when it comes to the 737 MAX jets. Shares falling, not as much as Centene, though. Centene shares falling about 16% on declining membership, as we were talking about with the simulcast crew. And then staying in the health space, I wanted to highlight Hims and Hers Health once again. We know that they sort of settled their feud with Novo Nordisk. They saw a few upgrades today on the heels of that. Shares finishing about 6% higher. But let's talk about what is going on with Oracle after hours. Reporting just a couple minutes ago, shares now higher by about 6.5%. Some of the big headlines here, Romain, that full year 2026 CapEx, $50 billion is the number. Also, when it comes to revenue for 2026, $67 billion, and fiscal year 2027 revenue guidance of $90 billion. You add it all together, again, a pop in shares, but as I mentioned just a couple minutes ago, the bar was pretty low for Oracle.
Absolutely. One of the worst performing stocks in the S&P over the past 6 months. A lot of concern about that AI spend and the return or lack thereof on it. The revenue growth is still there. The profit growth is still there. But a big question mark, it's not in the press release, is what does that CapEx spend look like for the upcoming fiscal year? Rishi Jaluria joins us right now, Managing Director of Software Equity Research at RBC Capital Markets. All right, Rishi, let's first start off with the top and bottom line. Overall, this seems to be relatively in line with what the street was looking for.
Yeah, no, thanks so much for having me. I think that's exactly right. Like, things were relatively in line. RPO in line. OCI was a little bit ahead of my estimates. I will point out they did raise their outlook for FY27, so the next fiscal year, above what they gave us at the Analyst Day, maybe about, 6 months ago. But yeah, overall, I think inline quarter, exactly as you've been saying, what's really going to matter is the commentary on the call. I think that's more important than the actual numbers. And, what are they going to talk about in terms of CapEx and CapEx ramp? You saw some of the reports about the Abilene data center. So we're really looking for a lot more management commentary on their ability to finance and build out the infrastructure that they need.
When we talk about the $50 billion in CapEx that they've had basically on board for the fiscal 2026, which is the quarter, this is the last quarter of that we're in right now here, what would you be comfortable with hearing for 2027?
Yeah, look, I think I would be comfortable with two things. Number one is maintaining, because if they can maintain the CapEx and kind of the longer term CapEx outlook and actually have a higher revenue number, that shows us more efficiency, which is what they've kind of been promising. I think the second thing is, like, they've announced some financing, but just anything to kind of reiterate confidence that it can be a self-sustaining, self-fulfilling kind of build out, and that there's not more new capital that will be needed. I think those are the two big things investors will be looking for on the call.
Is that something that you're confident when it comes to the financing, and you think about the reports we were getting last week, that was one of the big reasons why you saw that plan with OpenAI scrapping that flagship AI data center, the financing, the idea that it can be sort of self-sustaining. What is your degree of confidence there?
Yeah, I'm mixed on that, and that's why I have a sector perform on Oracle, because I think two things, right? Number one is, what is their ability to actually build this out in the timeline to meet the demands, and if maybe they can benefit from excess capacity tailwinds from others if OpenAI isn't there to meet the demand, but can they really get all that money and finance it? And then what do the actual margins on that look like? I think to make the assumption to get to a self-financing state, you probably have to have them hit that 30 to 40% cloud AI infrastructure gross margin that they gave us at the analyst day sooner than later, right? And that could be actually a longer ramp to get there. So I think that's where I'm still on the sidelines on just the ability to do that without needing net new financing or without having to cut elsewhere in other parts of the business even further than they've already been doing.
And of course, Rishi, you are in equity research, but I wonder, how closely you're monitoring what's going on with the corporate credit side of things when it comes to a name like Oracle. As we were mentioning just a couple of minutes ago, you think about their 5-year CDS recently touching the highest level since January 2009. In your work analyzing the stock, what sort of takeaways are you gleaning there?
Yeah, no, absolutely. Look, I mean, even if I'm an equity analyst, it is something that I pay very close attention to. I think we all have to, and say, what signals is this telling us that might be missing, right? And it's showing about confidence in raising. And I think as I even build out my model, I have to start thinking about, well, what does this actually do to the bottom line, right? Because that's what matters at the end of the day. It's not just all about revenue growth. And, if they're going to have to pay higher interest rates and take on greater amounts of debt, that's going to be a knock against their bottom line, right? They're going to have to start paying cash interest. They're going to, start carrying this debt. What is this valuation? So it is still hinting to us that there is a lack of confidence in their ability, or in the market's ability to really just continue raising capital and actually have these fully funded out, and that they will be able to meet the long-term targets that they gave us at the analyst day.
I am curious, though, too, just about the idea of how much confidence you have in their discipline to do that. I mean, this company has gone through cycles like this before. With regards to the management and their ability to sort of manage those financial issues, do you think they're going to have the discipline to do it?
Look, I think the answer to that is yes, right? I think Oracle has committed to having OCI be the infrastructure for powering LLMs and for these scaled AI developments and for Stargate. And, I think they have a lot of levers they can pull out. You've seen them already do equity raising after, there was concerns that they might not actually be willing to do that. You've heard discussions about potential further layoffs in the business. So I think they are committed to this. I think they will, to whatever tools they have in their arsenal, to be able to meet that demand and basically be able to tell that narrative that this is that next-gen scaled-out AI infrastructure, and if AI is here to stay, which I think most of us believe it is, that they can be that AI cloud to power the next 5-10 years. So I think they're very committed to driving that narrative.
All right, Rishi, really appreciate the time. That is Rishi Jaluria, Managing Director of Software Equity Research over at RBC Capital Markets. Oracle shares currently higher by about 7% after hours. It's going to be a fascinating call a little bit later. And coming up on The Close, we're going to dissect how Oracle's spending plans stack up against the rest of the AI landscape. Charles Phillips, Managing Partner and Co-Founder at Recognize, joins us next. This is The Close. Well, we're keeping an eye on shares of Oracle after earnings, certainly popping in a big way, now higher by about 7.7%. And of course, CapEx, a big focus this quarter as the hyperscalers begin to execute on their AI spending plans. So let's discuss with Charles Phillips. He is Managing Partner and Co-Founder at Recognize. That is a tech-focused private equity firm. Charles, it's great to see you in person.
Good to see you.
So let's talk a little bit about CapEx, because that was something that investors and traders were already a bit concerned about. And then in the past few weeks, you add the SaaS apocalypse onto that list, sort of the existential fear that what we're seeing in AI, some of the developments that could really pose a threat for a lot of the business models of these software companies. And, I wonder how you're thinking through all these different cross currents.
Yeah, I think it's a little more complex and nuanced than investors may be seeing right now. There are a class of applications that are very simple that could be replaced or maybe new competitors created. But then there's some very critical things that are super complex, critical processes, data that's unique, that are integrated into these organizations. It would be crazy to try to replace some of those. So global payroll, medical records, general ledger, no one wants to do that, and they probably couldn't do that. So these things aren't all the same. So I tell people, if you look at a website, they view that as a SaaS application. Okay, that maybe has 500 lines of code. SAP has 400 million lines of code. So there's a wide range of complexity, and things at the top that are somewhat of a moat, I'll call it a walled garden, as I call it. Those things are going to be around, and AI will be layered on top of them by those companies themselves. So this is going to evolve.
Interesting. So, the way that you're speaking of it, AI is sort of being a layer on top of maybe those walled gardens. It sounds like what you're saying is this isn't necessarily in either or a black or white sort of question here.
Yeah, it depends on the application. So for SMB applications, for small companies, yes, some of that can be replaced. I doubt if companies actually build that, but there'd be a lot of new competitors. But at the high end, where it's very complex to the enterprise-grade applications, yeah, I think they will layer in AI. It'll be collaborative. It'll make those applications better. So if I can use AI to sense and respond and tell me that I need to order more, I still use the underlying record system to order that's already connected to suppliers to order that new supplies, but AI helped me know when to order. So think collaborating that way, that's going to be possible.
But what comes of the growth for the established players? If the barrier of entry for new entrants is going to be lower because of all of these AI tools, and particularly if you're, I assume if you're a newer company, you're probably going after newer companies or smaller companies. I would assume that there's a value proposition there that maybe the bigger folks wouldn't be able to offer.
Well, that's also true. A lot of these micro markets and micro verticals, the big companies aren't in them anyway. They're not big enough to be interesting. So there's a different set of companies down there that build usually pretty cruddy looking applications because they can't attract the best engineers. Those applications should get better now. There'll be new companies, and usually it's a domain expert from that vertical who moves into software. Now they can build some pretty good software. So that will be a good thing for customers on the low end.
I am curious just about sort of the evolution of Oracle. You were once president of the company way back when. It's changed a lot, of course, but at its core, it still is what it's always been. And I do wonder, do you see a long-term future for that business model, or does it have to change, given at least what we know or what we think we know now about AI?
Well, all these companies have been good at changing business models as the technology changed, and that's why they've survived for 30, 40, 50 years. And so, yes, there's always changing technology. That's a good thing. It usually means new opportunity, and customers are rebuying stuff they bought before in a new version of it. So I don't have any doubt that some of these leading companies, whether it's Workday or Oracle, all of them can evolve. People look at these companies and say, well, they can be replaced. Well, okay, look at Google, look at Anthropic, look at OpenAI. What do they run for payroll and HR? They run Workday. Why do they do that? Because it's too hard to do. It's a distraction. That's not where my highest and best use. Buy that from somebody who knows how to do that.
Yeah, muscle memory. I mean, it's a hard thing to compete against sort of that incumbency advantage here. I do want to talk about, your current role at Recognize. You are a tech-focused private equity firm. We're talking a lot about this turmoil that we've seen when it comes to a lot of these software-focused names. I mean, has that sort of opened up opportunity for you? How are you viewing the landscape right now?
It's an enormous opportunity for our companies because everybody, when you have a top-down trend that everybody's talking about in the board of directors, we got to do something in AI, that's good for our companies because that's what they're doing. They're implementing that and building digital services. But the use cases we're seeing are usually things that could not be done before, using unstructured data to do things. So we have one company, for instance, that built a smart application for cities, using cameras all over the city to detect when there's potholes, to detect when there's a house that's been, deteriorating, and automatically generate the work orders to send people out. Now, that data goes in a case management system that's a traditional SaaS application, but we wouldn't have known about. You couldn't do that before. Now you don't have to send people out to inspect. These are new use cases that are saving people money or doing things that couldn't be done before. Companies seem to be more interested in that. Let me do something innovative that's going to change either how customers react to me or lower costs or do something that I couldn't do before as opposed to replace this old system.
Yeah, that pothole thing. Does New York City, do they know that exists? Because it would help.
We're trying to do that.
In all seriousness, though, I mean, we've always heard this narrative about this kind of this winner-take-all when it comes to AI. I take it you don't necessarily buy that, do you?
Well, probably won't be winner-take-all. We have some very competitive companies out there, and people want choice, and these models are slightly good at different things depending on what you're using them for. And most companies I talk to have multiple models that they're using. They don't want to be beholden to one. So market shares may come and go, but I think it's good to have healthy competition. the real next layer of this is not so much the models, because they're all trained on public data, so they're going to do similar things over time. It's the inference layer, how you use the model. Now that you get past training, now let me apply that to existing data, to my use case, and proprietary data. That's the next wave of this.
All right, Charles, always a great conversation.
Good to see you.
Charles Phillips, managing partner and co-founder over at Recognize. When we come back, we're going to turn back to private markets as the Iran war intensifies, AI accelerates, and credit cracks, well, continue to pop up. Key catalyst that Sachin Khajuria, the founder and CIO over at Achilles, is here to talk about next on Bloomberg. All right, private markets facing major cross currents. Big asset managers like Apollo, like Blackrock, like Ares down sharply year to date, with the Iran war now straining sentiment, all while the AI spending engine stays humming. Joining us here to talk a little bit more about what exactly he is seeing is Sachin Khajuria. He's the founder and CIO over at Achilles Global Management. Great to have you here.
Thank you. Thank you for having me again.
I think we've talked so much on this show about the cracks that we're seeing in the credit markets. We've talked so much here about the lack of exit possibilities in the private equity space. Are you actually still running into the house that's on fire, or are you standing outside waiting for someone to put it out?
Well, look, right now, the market feels like it's a poly-crisis. So you had the tariff war, the trade war, the Ukraine war, the Iran war, and these are tail risks that come with little or no warning. But if you cut through the noise, as you said, it's the new money opportunity that's the most interesting for investors. So you mentioned private equity, digesting legacy assets that were maybe mispriced in risk in the previous decade. If those assets are sold at lower prices, just to clear the backlog, because the distributions are slower and lower. Well, if they're sold at lower prices, somebody is buying at lower prices. So it's important to see who's able to lean in to those opportunities.
I am curious, though. We've seen so many of these asset managers reluctant to even put it out there for sale because, of course, obviously it exposes potentially what it really is. Are you seeing a little bit more willingness, or I should say willingness, or are you seeing more of these companies being forced to finally come to the table and say, okay, fine, give me an offer?
I am. I mean, I think it's not a case of return of capital. The capital is being returned. It's about how much return on capital is being returned. And I think if you have a fund which is, let's say, 2015 to 18, that kind of vintage, pre-pandemic, and it still has, a good chunk of its inventory sitting on the shelf, eventually you have to kind of, move on because the IRRs are going to look, pretty weak. So I think that is going to happen. And as I said, that creates opportunities for those who can lean in. On the private credit side, we still have really interesting opportunities to lend to the core growth areas of the economy. You have data centers, energy supply, infrastructure. So although there are a series of, controlled implosions in the private credit landscape, I think those are the minority of what we're going to see going forward. And essentially what we'll see is a rewriting and upgrade in underwriting standards going forward.
Well, let's talk about who potentially is getting caught up in those controlled explosions. And I will be using that phrase again, retail investors. I mean, that has been the talk of the town over the past year or so. How do you expand this asset class, private markets, to retail investors? Now, I mean, we just got this headline in the past couple of minutes. Cliffwater's private credit fund said to see 7+ redemptions. They're certainly not alone when you think about what we're seeing over at Blackrock and other firms as well. And I wonder, when it comes to the individual investor, the retail investor, which is a pretty broad church, do you think that there is a structural misunderstanding about liquidity expectations for some of these funds?
I think education is the best defense. Understanding is the best defense. If you're a retail investor and you're buying public stocks, are you fully informed about what you're buying, or you're relying to a certain extent on reputation and the fact that it's liquid and everybody knows the company, you're buying shares in Apple or whatever. With private markets, it's much more difficult to really understand what you're getting into. And I think it's important to understand that we're in the very, very early stages of this expansion to retail investors. So I think there are bound to be some vehicles that don't work out. The prospectuses are big. There's a lot of hard work, smart people working on these things to make sure that people really understand what they're buying. But of course, it's going to be a challenge because ultimately you have to size your exposure to what you can't take out quickly. And when someone is selling you this product, it's difficult sometimes to understand.
How does the conversation potentially change around putting private assets in 401ks? Because that was also part of this push. And you think about Treasury Secretary Scott Bessent saying at the end of February that he doesn't want, quote, something rotten getting passed off to individual investors when it comes to PE assets. And he's got company, actually, from Senator Elizabeth Warren. They're on the same side of this issue. She has also said that we need to stop pushing these risky investments into Americans' retirement accounts. Certainly that has been a big goal of some of the big players in the private market industry. Do you think that, some of that urgency maybe is removed by the episode that we're living through right now?
I think selection is absolutely key. I mean, I get this question from friends of mine, relatives, all the time. They're successful in their own business. They have some savings. They've been marketed some private markets funds in one form or another. I think if you look at the major franchises, their flagship funds, that have delivered consistent alpha through market cycles, you're probably likely to, think that those are quite a good place to, examine opportunities. I think the issue is that most investors would not really know which are the best funds and firms to look at, and therefore education is really essential before they go into these kinds of decisions.
But this has got to be hard in this particular environment because, the whole sort of draw, to a certain extent, of sort of getting access to this as an individual investor was that for years, a lot of these folks were on the sidelines looking at these incredible, 20+% returns and wondering, why we can't get a piece of that. Now you're in a lower return environment. You're in an environment where there's a lot of cracks, so a lot of fear about what's there. And it's not to say long term, this won't work out well. But in the short term, I don't even understand how you sell that.
I think you have to, the onus is on the individual investor to do the homework and not skip the diligence. I'm sure the firms are going to be very careful how they package investments and how they sell. Long term, I think it's quite a good thing. If you look at the macro environment today, as I said, it seems like a poly-crisis of different risks. You have, different wars, you have the tariffs, you have the trade, and actually it could make sense if you're an individual investor to have part of your balance sheet in private assets to shield from daily volatility. The question is how, and the question is with whom, and I think that is going to take some time to figure out.
And Sachin, before we let you go, I am curious to hear your perspective on how things look different or similar when it comes to private equity versus private credit, because a lot of the conversation is centered on private credit, and we've sort of been talking about the two as a monolith here. Yeah,
they're different. The issue is both are experiencing turbulence, as we've talked about. For some time, you'd find that one is kind of growing at double-digit rates and the other one is a little slow, but they're both experiencing turbulence. The best thing is diversification. If you're going to look at having a balanced portfolio, you're going to look at a little bit of equity and debt. I'm still finding really good opportunities in both spheres, but certainly you have to be very selective, and the bar is much, much higher than it was even just a couple of years ago.
All right, Sachin, great conversation. Really appreciate you taking the time. That is Sachin Khajuria. He is founder and CIO over at Achilles. And before we head to break, a quick check on shares of Oracle in the after hours. Still soaring after market right now, up about 7.7% as we count down to that earnings call. This is The Close on Bloomberg. Well, as the Iran war enters its second week, alliances are being tested. Israeli Prime Minister Netanyahu saying he's not done with the war yet, while President Trump, on the other hand, is declaring that the conflict will end, quote, very soon. Also adding to the confusion, we had Energy Secretary Chris Wright deleting a social media post that had said that the U.S. Navy escorted a tanker through the Strait of Hormuz. That post has since been removed, and the White House also refuted that post. So for more on what comes next, we're joined by Richard Haass. He is President Emeritus at the Council on Foreign Relations, also Senior Counselor with Centerview Partners. Fantastic to have you here. There's certainly a lot to dig into, but sort of when you add it all together and look at it holistically, it seems like today, especially, Richard, that there have been a lot of mixed messages about the duration of this war, and when it comes to Israel and the U.S., what exactly the end game is.
Well, two things, Katie. One is Israel and the United States are not necessarily, they're not on the same page. Israel is prepared to fight a long-duration war. It continues to see all sorts of positives in further diminishing the capacity of Iran to rebuild its military, to really do a lot. Israel wants I won't say an open-ended war, but a long-duration war. I think the United States has increasingly come around to the point of view is we're not well positioned to withstand that. That the economic pain of the war is going to grow for us, the military costs of the war are growing for us, and we would like to bring this to an end. The problem with the U.S. position is it only took one to start the war, us, but it's going to take three to end it. And that's mean, first of all, the United States is going to have to, shall we say, lean on Israel, to be blunt, to bring the war to an end sooner than the prime minister wants. Even more difficult is the United States is going to have to persuade Iran to bring a war to this war to an end. And that I think is going to be the biggest challenge for this president, who increasingly wants to wrap this up, declare victory, declare mission accomplished. But again, he doesn't have the power to do that. He's got to bring Iran around.
Yeah, it's really interesting, too, when you think about how this war is being perceived in different parts of the world, because recent polling shows that certainly a minority of Americans support the action in Iran, whereas you compare what we're seeing in Israel, for example, the reception there, Richard, this has widespread support, maybe also due to the fact that Israel is just physically a lot closer to Iran than where we're sitting in the United States.
Your assessment's spot on. It's far more popular in Israel than it is here. Indeed, in Israel, which is a country that's divided about just about any and every issue you can think of, this is one of the few issues where there's a pretty good consensus. But Israel is largely set apart from all sorts of global economic consequences. The Israeli public favors this war. The public here, over 60% is against it. They want the president to be focusing on affordability. The Europeans and our allies there and in Asia, look at their stock markets, look at the cost of energy. They are increasingly uncomfortable. The Arab countries, a lot of them are unhappy. They weren't consulted about this, and they're bearing the brunt. It's their oil installations, potentially their water treatment centers that are going to be attacked by Iran. So there's a real disconnect here. And again, the pressure to end this war is going to grow, but that very desire gives the Iranian leadership leverage.
And I am curious about that leverage. There's been a lot of speculation as to whether the U.S. would at least try to walk away from this, not so much in the sense of the traditional military sense, but the idea that the president, might just have other priorities and decide, okay, enough's enough. If that were the case, not saying the U.S. would completely pull out, what would you actually need to create stability there? The presumption is that Israel can't do it on its own. Would the Arab states maybe step up in some sort of cohesive way? I know they don't necessarily all cooperate now, but is there some potential for cooperation in order to sort of try to bring some stability back to that area?
It all depends upon what Iran's demands are. Iran will continue to have, for example, drones that they could use. It's going to be very hard to insure tankers going through the Straits of Hormuz. So the question is, what will Iran's demands be, and who's going to pay them? What if Iran says we want to have economic sanctions reduced or relieved? What if they say, this is not inconceivable, they're going to say it, what about reparations and so forth? And then there's going to be debates about their military rebuilding, about their nuclear program. All this is going to suddenly reemerge on the agenda, potentially as the cost of bringing this war to an end. And it's not clear to me that this administration, the Trump administration, much less others, have thought through what is it they're prepared to do to bring this war to an end.
I am also curious about the nuclear issue, which seems to be not really being talked about at all. I don't know what their capabilities were heading into this war a week or so ago, but is there any sort of risk that there is any facilities or, more importantly, uranium or anything else that could potentially be fall into the wrong hands?
Well, the answer is yes. You've got a significant amount of enriched uranium, not enriched to the level you'd need for a nuclear explosive device, but significantly enriched, reportedly a large amount in the area of the city of Isfahan. So that in and of itself could create a dirty bomb, a nuclear event if it got into the wrong hands. Also, if someone got a hold of it who actually knew how to further enrich uranium, it could be a nightmare. So I would think, just like that was part of the negotiations before this war began 2-3 weeks ago, I expect it's going to become, yet again, part of the conversation between the United States and Iran. What will be the disposition or the fate of that uranium? There's talk about even, in the out there conversation of the United States sending in special forces to try to get physical control of that. I would just say that would be extraordinarily difficult and dangerous operation to undertake. But that is one of the many unresolved issues here.
And Richard, at what point, over what timeline would you expect that diplomacy actually does start to play a role here? Because President Trump has said that he's open to talking to Iran. The administration officials have also said as much in the past day or so. Iran, though, does not seem to share that sentiment, to put it mildly. So at what point do you think that we actually do see some of those discussions happening between these two sides?
Well, you've put your finger on a big problem. It's not going to happen fast enough or quick enough. The economic effects are going to mushroom in this country and around the world. And the idea that you could negotiate an entire new package between the United States and Iran quickly or soon enough to alleviate the economic problems, I think is far-fetched. So you may have to do this in phases. And again, we're at an extraordinarily difficult point. The single biggest variable right now is the duration of this war. And we've got a problem. We want to bring it to a close. Iran sees leverage in that, and I think that is the biggest area of friction going forward. And Iran is in a position where it can continue to make the United States and the world pay if this war continues.
I am curious, though, Richard, and particularly about the U.S. strategy. And I know there's a lot of speculation that there wasn't a whole lot of planning leading up to this. But I think back to the Gulf Wars, primarily under George W. Bush, with Iraq and Afghanistan, and just how many military ships, U.S. naval ships that we saw in the Persian Gulf, not just necessarily to protect whatever cargo was coming out of the Persian Gulf, but also to protect some of the other Arab states and the folks there. There's no visibility, at least from what we know publicly right now, of that presence. And I am wondering if maybe that in and of itself could potentially help to just have more of that military presence rather than just, flying over and, dropping bombs and missiles.
Look, you're right. The presence compared to what we had in the Gulf War, 1990-91, as well as in the Iraq War, it's small. But there's no amount of presence that can necessarily keep the straits open if you have periodic attacks. Tankers are vulnerable. The last time we escorted vessels was, close to 40, 50 years ago. Again, an awfully difficult kind of operation. No, what you put your finger on is in some ways the lack of planning here, or to the extent planning happened, it was predicated on all sorts of optimistic assumptions about how this war would go and the potential for regime change in Iran and so forth. And it's not working out that way. And we're now in the very awkward situation where, again, we've launched something and we want to bring it to a close. Yeah. Iran senses that, and that they're going to try to use that to get some economic or political gain from the United States. We're going to have to make some tough decisions.
All right, Richard, really appreciate it. Dr. Richard Haass there, President Emeritus over at the Council on Foreign Relations, now a senior counselor over at Centerview Partners. When we come back, we are going to talk about the potential inflationary impact of what's been happening overseas. A big CPI report tomorrow. It won't encompass what happened in Iran, but of course, the look ahead just might. That's coming up next, right here on The Close. All right, we are less than 24 hours away from that exciting February CPI report. Bloomberg Economics anticipating a subdued core reading, though inflation hotspots do persist in areas like consumer electronics and recreation goods and services, though. That could potentially be offset by what? Chief U.S. economist for Bloomberg Economics, Anna Wong, joining us right now to give us a preview. All right, let's get right to it. CPI month over month, the survey about 0.3%. That's an acceleration. Core CPI, a deceleration to 0.2%. That's the estimates of economists surveyed by Bloomberg. Is that what Bloomberg Economics thinks?
Yes, we share the same assessment as the consensus. But I think the most interesting thing in this CPI report is to show that even before the war on Iran, we were already seeing two new supply shocks. Number one, a rise in consumer electronic shock in prices due to a global shortage of memory chips, meaning that your iPad, your computers, your laptops are going to see an increase in prices in the next couple of months. And second, there's also a rise in aluminum prices, in metal prices that started in December and January. That's filtering into higher prices in bicycles, baseball bats, your soda cans, that sort of stuff. So I think that will be what we will be looking for in the February CPI report.
Yeah, it's a good reminder that it wasn't exactly smooth sailing prior to the last 10, 11 days either. I am curious about what this all means for the Fed. Of course, they do meet next week. They're not going to have full data in hand when it comes to the inflationary impacts of what we're seeing in the Middle East. But you take a look at break-even expectations, particularly when it comes to some of those shorter durations, and they're on the rise here, Anna.
Yes, so the Fed right now is basically the hawks on the FOMC are calling the shots. And after the Fed have been cutting rates last fall, the doves are now in a less influential positions than the hawks. And of course, the Fed is forward-looking. They're looking at into March CPI, and we already have a good sense of what gasoline prices would look like in March. I think in the March CPI, we're going to get a super hot headline print, possibly of the magnitude of 0.6% on the headline, and for the year-over-year headline CPI to jump from 2.4%, which we're going to see tomorrow, to 3% in the next print. So being forward-looking, the Fed will sound rather hawkish next week.
All right, Anna, got to leave it there. Great to preview that 8:30 print tomorrow with you. That is Anna Wong of Bloomberg Economics. And also just, 8 days to go until that Fed decision?
All right. Well, so looking ahead to the next 24 hours, of course, we are going to actually have some earnings in the morning. That includes from Campbell's as well as Petco. A look at consumer staples here and how they've been actually holding up in terms of their tops and bottom lines. As Anna was just talking about, though, 8:30 a.m., that is the big CPI report out of Washington.
Also at 8:30, we're going to hear from the Fed Vice Chair for Supervision, Michelle Bowman. She'll be speaking at the American Bankers Association Washington Summit. So some split screen programming going on.
We're also going to get an update on the U.S. federal budget. That comes out at 2 p.m. So a lot of stuff coming out of Washington. And of course, our continued coverage of the situation in Iran and the U.S. response to it. More on that at the top of the hour with the team from Balance of Power right here on Bloomberg.